Welcome to another episode of What's on Your Mind. In this episode, I'm going to be speaking to Cathey and Hichem Djouhri about their views on the markets and what lies ahead. But before I get into that, I want to remind you guys watching that if you're enjoying our What's on Your Mind series content, then head over to our website, itpm.com, where we've got a bunch of different educational resources up there for you. So whether it's things like our online courses that teach you how to build and manage your own portfolios, or our mentoring programs, which help you practically implement all that knowledge in the courses under the supervision of guys like Hichem and Chris here, or whether you're just looking for more information on our live events that we do around the world. Now, speaking of those live events, we've got one coming up in London on the 15th of June. It's a super conference, so it differs slightly from the seminars that we have elsewhere around the world. And basically, it will be a full day of presentations given by guys that you see in the What's on Your Mind video series here, giving presentations on various trading topics. So it's always a great day. The students get loads out of it, and it's up on the website now under the seminar section of the website. So try and get your tickets for that because they sell out really quickly, especially if you're thinking about getting those VIP tickets. I know they went very, very quickly for our New York conference that we did a few months ago. And just another point on these super conferences, for you guys that are familiar with them, you'll know that we usually do two of those a year, one in London and one in New York. We alternate between the two. This year, unfortunately, due to time constraints from our senior mentors and picking up a lot of students and trading their own money, unfortunately, we only have time to do one of these super conferences. So again, make sure you do get those tickets if you can, because the places will go really, really quickly. So getting back to the show now, and speaking of live events in the UK, there's this ever looming Brexit leave date on March the 29th. And Chris, why don't you give us a little bit of an update on your thoughts on that?
Okay, cheers, Chris. Yeah, apologies for this, Hichem, but it's going to be quite UK-centric just for the start anyway. But
it's fine. It's funny to say.
Exactly. Well, I mean, Chris and I are in the UK, so I guess anybody else in the UK, you can't move for Brexit at the moment. It's kind of just overkill. And actually, just a point, yesterday, the day before, actually the House of Commons closed for 3 hours in the afternoon because the government had nothing to do. It's like sort of everybody's forgotten there's actually a country to run, and Brexit has just completely taken over everything. You literally could not make this up. But right here, right now, where we stand is that Article 50, UK leaves the EU on March the 29th. Everything being equal. Now, right here, right now as well, there is a talk about delaying that. But that needs to be ratified by all 27 countries in the EU, which is probably reasonably likely. However, in my opinion, I think this is just delaying inevitable because ultimately no deal seems to be forthcoming. And the two options really on the table right here, right now, are obviously a sort of a hard Brexit, no deal, and a soft Brexit with some kind of negotiated sort of exit between the UK and Europe. Just to run you through what this means, from a soft Brexit perspective, that means the UK maintains access to the European markets. It will also probably have sort of free movement of people, and pretty much nothing really changed in terms of the economics. The UK will still be subject to EU law, and the UK will continue to make its payments into the EU, which will amounts to around about £39 billion. And there will remain a constant open border between Northern Ireland and the Republic of Ireland, which is a slight confusion, which is all this talk about the backstop, which is going on, because Northern Ireland is obviously part of the UK and the Republic of Ireland is part of the EU. So we have a land border, which is sort of complicating the issue a little bit. That's the soft Brexit. The hard Brexit is the UK leaves with no deal, no negotiation. We no longer have free access to the European markets. There's no free movement of people between the UK and Europe. And the UK now is only subject to UK laws. Also, there is no payment from the UK to the EU. And there is the potential of a hard border, a land border between Northern Ireland and the Republic of Ireland, and the issues that it brings, given the sort of the peace treaty, which is negotiated about 20 years ago to end the sort of troubles in Northern Ireland. So they're the sort of the two kind of most likely scenarios in terms of the sort of deal or no deal scenario. But what does actually happens? What do we do going forward? Well, Theresa May tried to push the soft Brexit, and that was rejected by Parliament. So that seems to be dead in the water unless there's some renegotiation or some change in terms. And ultimately, the EU has to punish the UK for leaving Europe. Otherwise, what's the point of having the EU? Either financially, which is maintaining the payments from the UK into Europe and continue to be subject to European law, or they have to push them economically by restricting access to the European markets. So it's difficult to get too bullish right here, right now. But I think one of the things that I really take about it, looking at the UK government, is that they are kind of redefining what ineptitude means. The UK government could not have done this worse, in my opinion. Absolutely amateurish. The main reason is that the UK government does not realise that if you look at the trade between the UK and Europe, UK is the EU's internal largest client. This is bad for the UK, but it's a hell of a lot worse for Germany and the Netherlands. Right here, right now, the UK, Germany had about a £50 billion $50 billion trade deficit. So we import about $100 billion of goods from Germany. We export around about 50 billion. With the Netherlands, it's around about a $40 billion trade deficit. So if there are if there's no deal, then EU and the UK trade reverts to World Trade Organization terms, which means that the average UK exports to Europe will have a tariff of around about 4.5%. Exports from the EU into the UK have an average of around about 5.5%. However, there's a huge range between different sectors. Ultimately, very, very negative for anything related to food and beverages. The UK is a huge importer of food and beverages from Europe, and also anything regarded to autos. Clearly, the big risk here is the German car manufacturers and anything related to the auto supply chain. So the obvious names: BMW, Daimler, Volkswagen, Continental. But also another sector to be aware of is the chemical sector. Farmers actually have no tariffs. However, heavy chemicals have around about a 15%, it's 10 to 15% tariff. So very, very negative for the German chemical companies and also the Dutch chemical companies. So that is the sort of the financial backdrop to a no deal. On a relative basis, looking within the UK, everybody's looking against UK sectors against each other. A no deal Brexit would be pretty much neutral for anything aerospace. A relative winner would be pharma, financial services, and a loser would be obviously anything auto. We've seen the news from Nissan, but that's obviously a Japanese company. But anything related to the auto supply chain, food and beverages, and very, very negative for the supermarkets, obviously, because the UK is a huge importer of food and the associated tariffs that will come with it. So if there's no deal, yes, it's bad for the UK, but realistically, Germany, the Netherlands will be in recession by year end. And this is a backdrop to, just to put the context in Europe, obviously Merkel is leaving power at some stage over the next 18 months, even shorter. And the German corporate sector has woken up to what Brexit, no deal Brexit actually means. If we look at the ZEW indicator for corporate sentiment in Germany, it's completely fallen off a cliff. Slight bounce last year, but this has been one-way traffic. Exactly the same for the German manufacturing PMI, and the outlook for which was reported in January, so last month, it's actually below where it was. It's the lowest number since November 2014. The German corporate sector expects a no-deal Brexit. Now, what does this mean? Germany's in recession, and what does that mean for the EU? I think there's a real risk that if there's no deal, then the EU falls apart within probably 24 months. And just to sort of put in there, what does it mean for currencies? So just wanted to flag, since the referendum, so June 2016, the pound is down around about 8% against the dollar. It's rallied, actually, we've had a rally recently, but it went down about 8%. The euro, even though I've just explained how this is potentially more negative for Europe, the euro is actually up 1.5% against the dollar over the same period. Now, we've been talking about this for the last few months, and the trade's made about 5-6% over the last couple of months, being long the pound, short the euro. But that's kind of the backdrop to sort of my take on Brexit. So no deal is obviously bad for the UK, but a lot worse for Germany, Netherlands, and the EU in general. Now, also, so if Germany goes into recession, there's no deal. Germany goes into recession. Netherlands goes into recession. Italy is already in recession. What happens in Europe? ECB rate is at zero. Rates have been at zero for probably around about 4 or 5 years. Growth, GDP growth in Europe is bouncing around about 2%. So okay, but a little bit tepid. Inflation is around about 2%. So we've got basically zero interest rates and real interest rates in Europe. And the ECB put quantitative easing on hold in December. Big mistake. Big mistake. If Germany goes into recession, the EU is going to have to start buying assets again. Quantitative easing has to start to kick because to stave off a potential recession. So what happens? What do we do? It seems to me it's very easy to sort of have no reasons to do anything. But right here, right now, I think any rallies in Europe should be sold. But what do you think, Hichem? I know I've rattled on for a while, but Brexit's at the forefront of everything here. Sorry.
It really is. I mean, and you're touching on some very important points. What I wanted to talk about, just to sort of funnel it back into what the points that you're touching on, is to talk a little bit about what happened in 2018, and then bring it sort of to take a bit of a look backwards and see where markets are headed this year. So I mean, 2018 started and finished with a big bang, but in very different directions. Yeah. So I mean, the first part of 2018 was mainly sort of characterized by excess to the upside, driven by optimism and abundant liquidity, producing strong performance for risk assets across. But there's also some negative divergence that we've seen. This sort of the second part of 2018 was a wake-up call to investors across asset classes, when all the factors that didn't matter previously suddenly became of the utmost importance. The last month of the year in particular will be remembered as the worst December that we've seen in the U.S. market since the Great Depression, which left the U.S. market down for the year, which is the first decline in about a decade. Last year, global markets lost about $12 trillion, which is sort of the second largest market cap loss in history, behind 2008. So very, very significant numbers, but the fundamentals are different. So from a macro perspective, U.S. economy and corporate profits were bright spots for the year, but the emergence of tariffs, tighter Fed policy, oil price volatility, and weaker global growth, due to some of the points that Chris was talking about, created a more balanced ledger of tailwinds and risk than we've experienced in many years. However, what's really interesting about 2019 was the main winner. And the main winner was cash. So for the first time since 1994, cash actually outperformed equities and bonds. You need to go back to all the way to 1969 for the last time that cash returns were positive, while equity, credits, and government bonds were all negative. So these exceptional circumstances mean that the large majority of asset allocators and hedge funds delivered negative returns in 2018. And for a lot of hedge funds, it's the worst year that they've had since 2011. And from the chart that you guys can see, this is sort of the percentage of assets with a negative total return in US dollars, and you can see the cash return there at the end. Ironically, also, the best performing market was Middle Eastern equities. And I'd say ironically, the volatility in oil prices and the geopolitical environment that's taking place there. So if we look at the S&P Pan-Arab Index, ended the year in positive territory. It was up about 6%, despite a pullback in Q4. And Saudi Arabian market was actually ranked number 1 in 2018 in terms of global equity performance. This is in US dollar terms. And the Qatari market follows closely behind. What's also interesting is that we can now comfortably say that volatility is back. It's been sort of dormant for many years, but it made a strong comeback in the second half of the year. So despite the negative growth effect, if you look at the VIX or the VIX ETFs, it was up about 78% in 2018, and all of this was achieved in the fourth quarter. From a sector point of view, sort of leadership reverted in the last quarter of the year. So defensive sectors, utilities, healthcare, and consumer staples strongly outperformed cyclicals. Utilities in the fourth quarter ended flat. Energy was down 24%. Industrials were down about 19%. Despite the sharp sell-off and the FANGs stocks since the end of September, technology is still amongst the best performing in 2018. It was only down 4%, behind the utilities and healthcare. So the worst performing sectors were energy and materials, which were down about 25 and 20% each. So, as we've highlighted before, 2018 was a challenging year for investors. But before we move to 2019 outlook, there's some. I want to talk about the important lessons that we learned in 2018, and this helps the stage, or sort of set the stage for the coming year. So, what was very important for me particularly was geopolitics, and I mean we're talking about this. And Chris, you're mentioning what's happening in the UK and EU. So politics definitely play an important role, more so now than they have in the past. So in the US dollar, where the real GDP is estimated to have grown by about 3%, which is the strongest year actually since 2018, and higher than 2% sort of the rate that we've seen during the expansion. At the same time, US unemployment rate reached the lowest levels in half a century. US economy added about 2.3 million jobs in 2018. Corporate profits or earnings were up by about 20%, and this is the strongest growth that we've seen in eight years. So at the same time, you had a lot of attention deviated to the US-China trade relationship, the EU-Italy budget tensions. We talked about the UK as well. So all of this is playing an important factor. Also, the second sort of important lesson was, that as we were talking about earlier, higher rates do hurt. So U.S. short-term yields have been a key story in 2018 for mainly two reasons. One, made cash more sort of a viable alternative to riskier assets for U.S. dollar-funded investors. For example, the two-year tip yield, which after inflation sort of is at about 1.9%, which is the first time it reaches in about a decade. Yeah. And then the current context of geopolitical risk has become more difficult for these assets to compete with the higher two-year tip yield. Yeah. And also sort of raising rates hurt because they expose markets with weaker fundamentals, especially from an EM perspective.
Yeah, absolutely. Yeah.
Yeah. So I mean, moving towards 2019, so financial market volatility is back again. The outlook for this year is uncertain. In that context, it's important for our viewers not to overreact to market noise and rather try to answer some key questions such as what is the state of the global economy today? What are the chances of recession? And what is currently priced in by the markets? In terms of global growth, I think we're still sitting pretty. Global growth is expected to slow down for about 3.8 to 3.5%, but those are still decent numbers. So this current economic expansion, which is one of the longest that we've seen in history, has been going through many cycles over the past few years. For instance, it slowed down in 2016 and then picked back up in 17 and 18 due to the effects of oil price on U.S. activity. And the cycle again looks to slow down in 2018. Particularly with what's happening with the rates. Yeah. That being said, I think that the U.S. market will continue to outperform other developed markets, but the question really is for how long. So the U.S. has a few things going for them. We talked about the unemployment rate. We talked about growth in the economy, and wages are increasing at about 3.1%, and core inflation still at 2.2%. You combine that with a lower oil price, gives you sort of gives you a good tailwind to the economy, particularly from a consumer spending perspective. One thing I wanted to mention was on capex, which hasn't been really strong in the past 2 years, despite profits, as I was mentioning earlier, were up 20% in 2018. So, if we do see capex come back into the market due to a combination of tax cuts, that could be, and repatriation of overseas profit, this could give a push to the market overall.
Yes. Especially the U.S. market.
Yeah, particularly. I mean, we also face some key risks. We have, gridlock in Washington, It's creating clashes, and we keep seeing repeated shutdowns. You have an increase in U.S. T-bills. The auctions in the bid to cover ratio start to decline, as investors start to become a bit jittery. If we look at the U.S. 2-year and 10-year yield curve inverts, it has a negative impact on equity and credit markets. These are just some, and of course QE. So if the Fed decides to stay behind the curve and lose control on U.S. inflation due to wage growth, this could pressure U.S. corporate margins. And to bring it back to a little bit to what you were talking about, Chris, in terms of risks for 2019 from an EU perspective, slower growth could trigger further appreciation of the dollar. That's slower growth in Europe. The end of ECB QE lowers the demand for global bonds. The escalation of yellow vest protests in France and even further social unrest in the rest of Europe. The surge of populist parties across the board. The situation in Italy all cause a bit of a risk there. And obviously in the UK, if no deal is agreed, and then we could see a slowdown there.
I must admit, Hichem, you touched on some great points there. I'd like just to flag that, you said corporate US was up, earnings were about 20%. I mean, for 2019, the forecast is only around about a 5% growth. So there's not a lot of room for any disappointment if we're looking for 5% from the S&P 500 over the next 12 months in terms of profit growth. Right. Also, you touched on sort of credit being tighter in the US and the Fed potentially being behind the curve if wage inflation starts to tick up. I just wanted to flag that the spread between the 2-year and the 10-year US government is around about 15-20 pips. So we've got a pretty flat yield curve. Think about this time last year, it was more like around about 25 to 50, it's more about 50 to 60 pips. 2017, it was more like about 100 to 125 pips. So we've got a big flattening of the US yield curve. Now, typically, that means that the US is going to be in recession probably within sort of 12 to 18 months. What does this mean for equities? So they're only looking for 5% corporate profit growth in the S&P. It's difficult to get too bullish because you mentioned about the outperformance in the US. I would imagine US against everything else is probably about as wide as it's ever been. And looking for the mean reversion is always dangerous because your timing has to be perfect. But generally, I think the risk reward is to be long the US and short everything else has been a great trade. But I think going forward for this year, that might be dangerous. And I think you made an excellent point when you said that the financial volatility in financial assets is back. I think that is going to continue for the rest of the year.
But do you guys see opportunities to take advantage of what may be a mean reversion or not? Because we've talked about Europe and Britain potentially not being that great. Are there any sort of places around the world that could be good for equities, or are you thinking more about other asset classes?
Well, I think... Go ahead, Hichem.
No. All you.
I was thinking sort of... Now, we talked about the kind of... It is a sort of kind of counterintuitive right here now, but long the pound, short the euro has worked over the last few weeks, and I think it's going to continue. I think you mentioned, Hichem, about the that technology was still up about 4% on the year. It's still the fourth best performance sector in the US. I think over the last few weeks in the US, we've seen a definite rotation out of defensives, which were leading the market in the last quarter. They've been underperforming, and there's clearly been some big buying back in the air, some of the growth stocks. You mentioned the FANGs, but there's definitely been a rotation out of defensives into FANGs. I would look for any trade to reverse that. Personally, I'd be looking to reverse that to be long defensives and short anything growth and anything cyclical, because I think the US the yield curve is telling you don't want to be long anything growth or cyclical right here right now.
Sure. I mean, it's interesting, as you're saying, in terms of EPS expectations that have been revised down to 5%. It's still the most positive EPS expectations when we talk about expectations from a global perspective. Absolutely. So that gives you an idea of where investors are looking at. We are seeing wage growth picking up now. So So U.S. consumption is picking up thanks to this sort of rise in disposable income and higher unemployment.
Yeah.
So I think instead of looking at it from a market or geography perspective, as Chris you were talking about, it's very much a sector play
Very much so.
here.
Yeah.
Yeah. So the expensive valuations are usually, or investors look at them as reasons to be bearish on
Yeah.
U.S. equities. But on the back of that Q4 correction, the S&P now trades on a 12-month forward PE of 14.5 times, which is in line with the 10-year average. So as far as relative valuation is concerned, the equity risk premium, the earnings yield of the treasury yield is over about 300 bips right now, which is about 2 standard deviations above average, indicating that equities are cheaper than bonds. But is it really the market that you want to be in? I think so, but you have to really be careful about where which markets you want to be. So there's a lot of things to watch out for currently.
Yeah, exactly. So
yeah,
like you said, volatility is here. I think it's here to stay for a while. And we've talked about sort of how to trade in more volatile markets to shorten the time frame and reduce the position sizes and just give yourself flexibility. I think that's the key.
Yeah.
Flexibility is the key for this year.
Yeah, I'd really look at movements in the US dollar as well. So
absolutely.
Sort of any weakness in the USD could or any US-China trade war resolution or change in the rhetoric would be very positive for other markets or ex-US markets that have really disconnected from the US. We've seen sort of the US market going one direction and the rest of the world going another way. So that could be the main catalyst or trigger for the EU equities or EM equities. I mean, EU equities had a perfect storm last year between deteriorating macro data, the Italian budget, Brexit, trade tariffs, and China's slowdown impacting EU exports. So it led to this underperformance.
Absolutely.
Yeah, valuations are not so bad. I mean, Europe's trading at about 12 times forward PE. Risk premium is at record level sort of lows, and earning expectations, have continued to be revised downwards. So exactly. 10% for next year. But that's where opportunities. Those are the areas where opportunities emerge.
I completely agree with you, mate. I completely agree. I think the risk reward is. Clearly, last year, long the US, short everything else was great. This year, the risk reward I don't think is in your favour to have that trade on. It could continue, but I think the risk reward of any big move is against it.
Cool. Well, I think that's all we actually have time for this week on this episode of What's on Your Mind. As always, it's a great conversation with you guys. I look forward to kind of catching up and seeing where these things have gone in a few weeks' time. But just to kind of finish up, to remind you guys watching as well, if you're enjoying this content that we provide and you want to learn more and make use of our educational resources, then head to our website, itpm.com. As I said at the beginning of the video, we've got things like our online courses to help you build and manage your own portfolios. We've got mentoring programs as well available there. So that's with guys like Hichem and Chris here that can really help you progress and practically implement that knowledge from the courses. And of course, information on our live events up there as well. So those live events, the information can all be found at itpm.com/seminars. And like I said at the beginning, we've got a big one coming up. It's the London Super Conference on the 15th of June. Try and head to that if you can. All these guys that you see on the What's on Your Mind episodes will be speaking at that conference. So it should be a really good event. And especially if you're thinking about getting those VIP tickets, get them quick because they sell out really, really fast. So that's all from us. I hope you guys enjoyed the show and make sure you join us next time for another episode of What's on Your Mind.